Futures trading is often portrayed as either a shortcut to fast profits or a dangerous arena reserved only for professionals, and both descriptions miss the deeper reality. Futures are not inherently good or bad. They are instruments of leverage obligation and precision, and because of that, they amplify whatever mindset and discipline the trader brings into them. For those who approach futures casually, they accelerate mistakes. For those who understand their structure and respect their risks, they become powerful tools for hedging speculation and market participation that few other instruments can match. At the most fundamental level, a futures contract is an agreement to buy or sell an underlying asset at a predetermined price on a specific future date. The underlying asset can be a physical commodity like oil, gold, or wheat, or a financial instrument such as a stock index, interest rate, or currency. Unlike stocks, futures do not represent ownership. They represent commitment. When you enter a futures contract, you are legally obligated to fulfill that contract unless you close or roll the position before expiration. This obligation is what gives futures their efficiency and their danger. One of the defining characteristics of futures trading is leverage. Futures allow you to control a large notional value with a relatively small amount of capital, known as margin. This margin is not a down payment. It is a performance bond. It exists to ensure you can absorb daily gains and losses. Because of this structure, small price movements in the underlying asset can result in large percentage changes in your account. Leverage compresses time. Profits and losses that might take months in other markets can occur in days or hours in futures. Another core feature is mark-to-market settlement. Futures positions are settled daily. At the end of each trading session, gains are credited and losses are debited from your account based on that day's price movement. If losses reduce your account below maintenance margin, you must add funds or your position may be liquidated. This system reduces counterparty risk at the exchange level, but it places constant pressure on the trader. Futures do not allow you to hide from losses or delay decisions. Every day the market forces an honest reckoning. Understanding why futures exist helps clarify how they should be used. Futures markets were created primarily for hedging, not speculation. Farmers locked in prices for crops before harvest. Airlines hedged fuel costs. Manufacturers stabilized input expenses. Speculators entered later, providing liquidity and absorbing risk in exchange for potential profit. This dual structure still exists today. Every futures trade reflects a transfer of risk between parties with different needs and time horizons. Seeing yourself clearly as a hedger or a speculator matters because each role demands different expectations and discipline. Futures pricing itself is more complex than simply forecasting where price will go. Futures prices incorporate expectations about supply and demand, storage costs, interest rates, and convenience yield. This leads to conditions known as contango and backwardation, where futures prices differ from spot prices in systematic ways. These structures matter deeply for anyone holding futures over time or rolling contracts because they can create gains or losses independent of price direction. Many beginners are surprised to lose money even when the underlying asset moves in their favor simply because they did not understand the cost of carry embedded in the contract. Liquidity and standardization are among the great strengths of futures markets. Contracts are standardized by exchanges in terms of size, expiration dates, and specifications. This standardization enables deep liquidity, tight spreads, and efficient price discovery. But it also removes flexibility. You cannot customize a futures contract to fit your exact needs. You must manage size, timing, and risk within the structure the market provides. Futures reward those who adapt to structure rather than fight it. Psychologically, futures trading is demanding. The combination of leveraged daily settlement and rapid feedback creates emotional intensity that many traders underestimate. Profits can feel intoxicating. Losses can feel personal and urgent. Without predefined risk limits, position sizing rules, and emotional control, traders often spiral into reactive behavior. Futures markets do not forgive hope or hesitation. They reward preparation and punish improvisation. Another critical distinction is between directional trading and risk management. Many traders enter futures believing they must predict direction to succeed. In reality, futures are often most effective as risk management tools. Index futures can hedge portfolio exposure. Interest rate futures can manage duration risk. Commodity futures can stabilize business costs. Even speculators benefit from thinking in terms of risk first and direction second. Direction creates opportunity. Risk determines survival. It is also important to recognize that futures are not long-term buy-and-hold instruments in the traditional sense. Contracts expire. Positions must be closed or rolled. Rolling introduces costs and complexity that compound over time. Futures are active instruments by design. Even long-term futures strategies require ongoing management. Treating futures like stocks is one of the fastest ways to experience confusion and loss. The accessibility of futures trading has increased dramatically, lowering barriers to entry. This accessibility is a double-edged sword. It invites participation without requiring understanding. Many traders encounter futures before they have built the habits necessary to survive leverage. The market does not care how new you are. It only responds to how prepared you are. A comprehensive understanding of futures trading begins not with strategies, but with respect for structure. Leverage margin settlement, expiration, and pricing mechanics define what is possible and what is dangerous. Before asking how to make money with futures, the more important question is how not to lose everything quickly. Futures are honest instruments. They expose weaknesses immediately. They do not wait for experience to catch up. As we go deeper, the real value comes from understanding how futures are actually used in practice, how different types of futures markets behave, how traders structure positions responsibly, and how risk is managed, so that leverage becomes a tool rather than a weapon. Because without that understanding, futures trading is not a strategy, it is a gamble. And that is why, before moving forward into specific strategies, contract types, and practical examples, we need to pause right here and carefully examine how futures contracts function across different asset classes, how margin and leverage should be handled in real-world conditions, and how a trader can decide whether futures even belong in their toolkit at all, which brings us directly to the next part, where we will continue by looking at how futures trading actually functions in practice across different markets, and how a trader should think about leverage margin and suitability before ever placing a real trade, because this is where theory meets consequences. Futures markets can be broadly grouped into commodities, financials, and interest rates, and each behaves differently despite sharing the same contract mechanics. Commodity futures such as crude oil, gold, or agricultural products are deeply influenced by physical supply chains, seasonality, geopolitics, and inventory cycles. These markets can move violently on news that affects real-world production or logistics, which means leverage must be handled with extreme caution. Financial futures, such as equity index futures, tend to be more liquid and structurally cleaner, but they transmit macro risk instantly and can gap sharply during crises. Interest rate futures are the most complex of all, reflecting expectations about policy, inflation, and growth, and they often punish traders who underestimate how fast narratives can change. Margin is the centerpiece of futures risk management, yet it is widely misunderstood. Initial margin determines how much capital is required to open a position, but it should never be mistaken for acceptable risk. A position sized to the margin requirement alone is almost always oversized. Professional traders treat margin as a minimum administrative requirement, not a sizing guide. Real position sizing is based on how much of the account can be lost if the trade goes wrong, and futures demand this calculation before entry, not after. Maintenance margin and margin calls enforce discipline externally, but relying on them as risk control is a sign of poor preparation. By the time a margin call arrives, control has already been lost. Leverage in futures should be viewed as a precision tool, not a growth engine. Using less leverage than allowed is not conservative, it is professional. Futures offer flexibility to scale exposure up or down efficiently, and the ability to trade small relative to account size is one of their greatest strengths when used correctly. Traders who survive long-term often use only a fraction of available leverage, accepting slower growth in exchange for psychological stability and staying power. Futures compress mistakes quickly, and restraint is what creates room to learn. Deciding whether futures belong in your toolkit requires brutal honesty. Futures are not necessary for most investors or traders. They are most appropriate for those who need efficient hedging, precise exposure, or have a well-tested strategy that benefits from leverage and liquidity. If your primary challenge is discipline, patience, or emotional control, futures will magnify those weaknesses rather than fix them. If your strategy works without leverage, adding futures too early often introduces more harm than benefit. Risk management in futures, trading must be layered. Hard stops define maximum loss. Position sizing limits account damage. Daily loss limits prevent emotional spirals. Time-based exits prevent capital from being trapped in unproductive positions. These layers exist because no single control is sufficient under leverage. Futures reward redundancy in risk control, not elegance. Perhaps the most important insight is that futures trading is a business of risk transfer, not prediction. Every futures trade involves someone hedging and someone speculating. The market does not care which role you believe you are playing. What matters is whether you understand the risks you are absorbing and whether you are being compensated appropriately. Traders who focus only on being right about direction miss the deeper game entirely. In the end, futures trading demands maturity. It strips away excuses and forces accountability daily. Used wisely, it offers unmatched efficiency and flexibility. Used casually, it delivers rapid, unforgiving lessons. A comprehensive understanding of futures is not measured by how many strategies you know, but by how rarely you put yourself in a position where one trade can define your future. If this guide helped clarify what futures trading truly involves, consider subscribing to stay with these long-form discussions that emphasize survival before profit, and leave a comment sharing what initially attracted you to futures, because understanding that motivation is often the first step in deciding whether futures should be a tool you use or one you deliberately avoid.